In this video, we define the critical relationship between implied and historical volatility. To understand option pricing, we must distinguish between the rearview mirror and the windshield. Historical volatility, or HV, measures the annualized standard deviation of past price movements. What actually happened? Implied volatility, or 4, is the market's consensus estimate of future movement derived directly from current option prices. The relationship between these two metrics tells us if options are expensive or cheap. When 4 is significantly higher than HV, the market is pricing in more turbulence than the stock has recently exhibited. This volatility premium inflates option prices, creating a statistical edge for option sellers who believe the fear is overstated. Conversely, when 4 is lower than HV, the market is complacent, expecting price action to calm down despite recent swings. Here, option premiums are theoretically undervalued. If you believe the stock will continue to move aggressively, this provides an opportunity to buy volatility at a discount. We quantify this edge by looking at the spread. If a stock has an 4 of 30% but a realized HV of only 20%, option sellers are effectively collecting a 10% premium over the actual risk, assuming the trend holds. We refer to this difference as the Volatility Risk Premium, and it is the foundational edge for strategies like Iron Condors. Ultimately, your strategy selection should align with this relationship. When the spread is positive and wide, prioritize net selling strategies to capture the crush. When the spread is negative or narrow, prioritize net buying strategies like Straddles or calendars to leverage cheap gamma. Thanks for watching, and see you in the next episode on Volatility Skew.